Your real estate portfolio, whether it's your personal home or an existing rental that you have, is likely your biggest asset. But for most Canadians, it's also their most underutilized resource. You might be sitting on hundreds of thousands of dollars in equity, but as long as it's trapped in those walls, it's earning you exactly 0%, if not a negative return if you account for inflation. It's doing nothing for your future. The smartest investors know that equity is the fuel for growth, but simply pulling that equity out through cash is not a strategy. You have to choose the right vehicle to access it, and you also have to have a plan to manage the risk of that additional debt. My name is Dalia Barsoum. I'm the founder of Streetwise Mortgages, a multi-award-winning mortgage brokerage that specializes in rental property financing. Welcome to the Streetwise 10. Today, we're answering question number 5, which is, what is the smartest way to use equity to buy a rental property? I am going to show you the exact steps we use to turn your underutilized equity into an active wealth builder. So stay tuned. First, let's look at the numbers. In Canada, you can generally refinance a property up to a maximum of 80% of its value. And that includes any existing mortgages plus any new funds that you are looking to take out. So let's use a real world example. Let's say that you have a home and that home is worth $1.2 million, and that the house has a first mortgage on it at 65% of its value, and that mortgage is, let's say, with a bank and equals $780,000. Because we can only take out a maximum of 80% of the value, this leaves you with this portion here, which is the accessible equity, and that would be 15%. That's the remainder of the 80%, 65% first mortgage, 15% for the equity portion that add up to 80%, and that number is $180,000. So how do you access this $180,000? The most powerful tools to access it for real estate investors is called a Readvanceable Mortgage. Many investors haven't heard of this term, but essentially it's a two-in-one product. It combines your traditional mortgage with a secured line of credit to access this equity. And the secured line of credit is called a HELOC. Here is where the magic happens. As you pay down the principal on this mortgage every month, the limit on the secured line of credit increases automatically by the same amount of that mortgage principal pay down. This means that you are constantly unlocking equity every single month without having to talk to a lawyer or requalify for additional money. Now, due to recent bank rule changes, this automatic increase now only happens when this mortgage balance goes below the 65%, but it's still an ultimate tool to help you access equity continuously once you've set up that original secured line of credit under the Readvanceable Mortgage product. Now, where do you find these advanceable mortgage products and how do you access them? This product is available with the top 6 banks: BMO, Scotiabank, RBC, TD National Bank, and CIBC, as well as with Manulife and various credit unions. To access it, you have 2 paths, and this is where you need to be careful. Path number 1 is if your current lender, let's say, offers a Readvanceable Mortgage product, what you can do is just tag on this secured line of credit over here, and that will go on the property without breaking your first mortgage. And that could be your cheapest path because you don't have to pay any penalties to do it. Path number 2 is to switch from your current mortgage provider, if they don't offer it, or if they're not willing to offer you the full 80% to another lender. But we have to be careful and run the cost-benefit analysis. Look at all of the penalties involved in breaking away from your current lender, as well as any costs associated with breaking that loan, and compare that to the benefits you're going to experience as a result of switching to this new product. So we always have to run a cost benefit and see if that makes sense. But these would be the two paths. Once you have that line of credit, here is the winning strategy. A mistake that I see some investors make is buying their next rental property entirely with cash from the line of credit. And while this may make sense in some cases because you may want to close on a deal fast, I do not suggest doing it this way for a couple of reasons. One, you're tying a big chunk of your capital to one asset, and that is a risk that goes against the diversification idea. You're putting all of your eggs in one basket. And then two, the interest on line of credits is typically higher than the interest rate on a mortgage. At the time of this recording, the prime rate in Canada is at 4.45%, and the line of credits are priced at prime to prime plus 1.5, where mortgages are currently priced in the threes. So the larger the amount you use from your line of credit, the larger the potential adverse impact on your rental property cash flow. Therefore, I suggest that you use the line of credit strictly for the down payment and the closing costs. And maybe if there are any renovations required on the property, to make it tenant ready. For the remaining 80% on the rental property that you're buying, I suggest that you seek a new mortgage against that rental property. This way you're not tying all of your line of credit capital to one asset. And this gives you the best of both worlds. You're maximizing leverage because you are borrowing to invest, but you're leaving room for your future investments. You're leaving room for potential renovations. You're leaving room for a cushion, and you're getting a good mortgage on the rental property itself. Qualifying for an advanceable mortgage with a secured line of credit requires strong income verification. Be proactive. Set this up when you don't need the money, not when you need it. Don't go and set up secured line of credits when you're between jobs, or if you've switched from employment to self-employment, or after you've added multiple properties to your portfolio, because the numbers will be different. The debt ratios, which are the metrics that the lenders use to determine how much mortgage or line of credit you qualify for, will become tighter. So you limit your ability to qualify for the 80% or to get this product. And that door can close. Therefore, be proactive. Set it up when you're in a good financial position and before your portfolio becomes too complex and when you do not need it. And then at some point down the road, you will utilize it and you don't have to requalify for it again. Now, even with the benefits that come with a secured line of credit and an advanceable mortgage product, clients still ask me, Dalia, is it too risky to set up the secured line of credit? And I want to address the top 3 fears that I see head on. The first one is the question about whether or not you are taking on extra debt. Well, here's the thing with a secured line of credit compared to a mortgage. With a mortgage, you're taking on debt right from day one, and you're paying principal and interest payment on the amount of the mortgage you got approved for. With a secured line of credit, you're not paying anything on day one. You only start to pay interest on the line of credit as you use the money, only on the amount that you have used. Now, if you end up using that line of credit to buy cars, to support your lifestyle, that is taking on bad debt. But I know that's not what you're gonna do. That line of credit is to help you build your future. It's going to go towards real estate assets that will generate cash flow and potentially appreciate in value. So you're putting it into a good use. You're using debt towards a good use. And again, you're not paying anything on that line until you start using the money. Fear number 2 is what's called a callable loan. So a line of credit is considered a demand loan. Technically, a bank can recall a demand loan, but the risk of that happening is super low if you are making your payments on your line of credit in time. The third fear is the fear of rising interest rates. Because line of credits are based on the prime rate, and prime rate fluctuates depending on what the Bank of Canada does with interest rates, there is a risk there that if the Bank of Canada raises the rates, the interest payment on the line of credit for the amount of money that you've used can also go up. Now, how can you hedge towards that risk? Basically, all lenders allow you to lock in all or a portion of the money that you used into a fixed rate mortgage. And that's how you deal with that particular fear with respect to rising rates. Equity is a power tool. It can build your wealth or it can stress you out if you don't know how to use it correctly. The key is to access the equity through the right vehicle and to set it up strategically and to plan around how to manage the risks. So if you're sitting currently on equity and wondering exactly how to fund your next deal and how to structure it, and want to understand the cost benefits associated with setting it up, reach out to one of our Streetwise advisors for a complimentary planning session by clicking on the link in the description. This was question number 5 in the Streetwise 10. Make sure you're subscribed to the channel and like the video if you found value in it. Share it with another investor to be of service, and watch for my next video where I am going to tackle the common question of whether you should take a fixed or a variable rate on your rental property. Thank you for watching, and as always, stay streetwise.